welcome to the Morningstar series Ask the Expert. I'm Emma Wall and I'm joined today by Shaun CIO of Nutmeg. Hello Shaun.
Good morning.
So we're running an active and passive week this week, and today we're focusing on the benefits of passives. So I'm just going to say to you, what are the benefits of passives?
Well, often people think of passives of just being a bit like your basic foods you get in the supermarket, your value baked beans, but they're much more than that. They're really precise tools that people like me, asset allocators, can choose to get good exposure to different markets, be very precise about what we're investing in, know what we're investing in, always be able to see what we've got, and actually at very low cost and really reliable returns. So if the FTSE is down by 1%, we know we're going to be down 1%, but if the FTSE is up, we know we're going to be up.
And that's one of the things you mentioned on there. They're not just about basics. I think many people think of passive funds as a way to gain access to, say, the most liquid of equity markets. But actually, they're incredibly diverse. If we take one sector, for example, commodities, finding an active manager that invests directly in commodities, in the underlying natural resource, is very difficult. The Barings Fund now is just equities only. The JP Morgan is equities only. So with a sector like commodities, passives can really offer something completely unique.
Yes, so you can target the mining sector if you like the stocks, or you can target the physical commodities by investing in funds that invest in futures. So whether you like energy, whether you like base metals or agriculture, there are ETFs particularly that will invest in those commodities. If you fancy the stocks, there's ETFs for those as well.
And what do you think that passives bring to a retail investor's portfolio that perhaps active management can't?
Well, I think they're really good for core part of particularly equity portfolios, long-term buy and hold. If you think about the cost now for investing in a FTSE 100 exchange-traded funds, that costs you £7 per year for £10,000 invested. That's incredibly low cost, and it makes it quite hard to beat that kind of low cost. So it's a really great building block for a portfolio to think about where do you want to invest. If you like, for instance, that you prefer one emerging market country rather than invest in the whole of emerging markets, you can be selective. And the same in Europe. If you just like German stocks rather than a pan-European fund, you can buy a German index fund as well. So there's a lot of precision that investors can use out of ETFs, whether you're a retail, whether you're institutional.
There's one thing we should mention though, they're not risk-free. I think a lot of people think of passives as a one-way bet. But of course, although you're never going to underperform the market, asset allocation is really key, because it's important to diversify, because if the market goes down, you are going to go down. So if you're only invested in that one market, that's all your money gone.
Absolutely. I think what exchange-traded funds and index funds give you is the ability to asset allocate, to choose where you're invested. But it's really important you follow that next step and invest where you should be investing, being really diversified across the world, across different asset classes. And index funds allow you to use those different asset classes really effectively.
Shaun, thank you very much.
Pleasure.
This is Emma Wall from Morningstar. Thank you for watching.